Welcome back to Analyst Bytes. If you follow the market, you've seen the paradox. Tech giants like Apple and Nvidia rally, pushing the S&P 500 to new highs, yet the Dow Jones seemed asleep or even red. Have you ever wondered how these moves are actually calculated? Or maybe you are building your own portfolio and struggling with allocation. How many shares of each stock should I actually buy? If that sounds like you are in the right place. Today, we are taking practical CFA Level 1 concepts to reveal the math behind the market moves. Instead of dry theory, let's understand index construction by watching 5 representative US stocks compete in 3 different rounds. Let's meet our contestants. First, Goldman Sachs. Look at the share price. As of January 15th, it's closing in on $1,000. In this arena, being expensive is his weapon. Second, Apple, a market veteran for over 40 years. While his price is lower, his market cap is a massive 3.8 trillion. Third, Nvidia, the shovel seller of the AI gold rush. With global capital flooding in, his market cap has surpassed Apple, reaching 4.55 trillion. Fourth, Intel, once the king of the dot-com era, unfortunately, missing the AI wave hit him hard. His market cap has shrunk significantly, dipping nearly 100 billion in mid-2025. Finally, Mara Holdings, a Bitcoin mining giant tied to the crypto circle. He represents the emerging tech and high volatility of small cap stocks. The 5 players are set. Now let's see how they perform under 3 different judges, our 3 index construction methods.
Round 1.
Now please welcome our first judge, the face of old money, the Dow Jones Industrial Average. This guy is strict and exclusive. For over a century, he has only invited 30 of the biggest blue chip giants into his circle. He follows a classic, maybe even stubborn rule. I treat everyone equally. Regardless of your market cap, I buy exactly 1 share of each stock. Remember this plain English rule. Buy 1 share. That is the secret behind price weighting in CFA Level 1. Since we are buying just 1 share of each, calculating returns is simple. While textbooks teach you to use the average price method, let's use a smarter shortcut for the real world. Think of the index as a portfolio. The initial value is simply the sum of prices of all stocks. Just focus on how this sum changes. Calculating the return based on this gives you the exact same result. Trust me, stick to the sum method. You will thank me later when we discuss stock splits. Let the games begin. To understand Mr. Dow's bias, let's run a quick test. We will put the most expensive stock, Goldman Sachs, against the cheaper Nvidia. The other players will sit this one out. Here are the real prices from January 15th. This is our baseline. Suppose 1 month later, Goldman Sachs jumps 10% while the others stay flat. What is the return of the entire index? 6.6%. Feel free to pause and calculate it yourself using the average price method or just the sum of prices. The results should be the same. Now it's Nvidia's turn. Same setup. The others stay put, but Nvidia rallies 10%. Guess the index return? Only 1.3%. Wait a minute, 6.6% versus 1.3%. That means Goldman Sachs moving 10% has 5 times the impact of Nvidia moving 10%. Sounds crazy, right? Especially since Nvidia's market cap is over 10 times larger than Goldman's. Why is this? Because in Dow's old money world, price is power. The logic is simple. Buying one share of Goldman costs nearly $1,000 in your pocket. Buying one share of Nvidia costs only $200 in your pocket. In a buy one share portfolio, high-priced stocks contribute more actual cash value. That is the secret of price weighting. It naturally loves expensive stocks and punishes the cheaper ones. Round one seems settled, but the market loves a plot twist. You've heard of stock splits, right? Let's look at Goldman Sachs again. Trading nearly $1,000, it's way too pricey for most regular folks. So Goldman decides on a 2-for-1 split. Instantly, the price gets slashed in half, from 975 down to 488. Here is a problem. Since Mr. Dow strictly buys only one share, the value of his holding just dropped by about 50%. Does the index crash? Of course not. Mr. Dow has a magic trick called Divisor adjustment. This is a key concept. The logic is simple. To stop a fake crash, the index value before and after the split must stay the same. Since the top number of sum of prices shrank, we have to shrink the bottom number, the divisor, as well. Using this formula, we calculate the new divisor as 3.3517. See? Even with the price cut, the index value stays perfectly at 296.02. Crisis averted. But the math is safe. But is Goldman's power safe? No. Let's run the numbers again. This is a huge blind spot for many students. After the split, if Goldman still rises 10%, does it still lift the index by 6.6 like before? Look, only 4.92%. It dropped from 6.6% to 4.9%. This is the brutal truth of price weighting. A stock split is basically a demotion. By lowering its share price, Goldman has lost its muscle in this price is king club. Finally, here is a survival tip for the exam. That new divisor formula is long and annoying, right? Here is the good news. You don't actually need it to calculate returns. Since the index value is smooth, to find the return, just focus on the sum of prices. Just take the new ending sum minus the new beginning sum and divide by the new beginning sum. You will find the answer is exactly the same, 4.92%. One less formula to memorize, one more point in the bag. Round 1 is over. Now let's move to round 2.
Round 2.
Now please welcome our second judge, the heavyweight champion, the S&P 500. Just look at him. He is the market. In CFA Level 1, we call him the ultimate proxy for US equities. Investors worldwide watch his every move. His selection rule is simple: money power. He picks the 500 largest, most liquid companies, and he plays favorites. The bigger you are, the more I buy. Since he buys based on market cap, is there an easy way to calculate returns? Absolutely. Let's make a bold simplification. Imagine Mr. S&P is rich enough to buy out all 500 companies entirely. Forget about share counts or weighting percentage. Under this logic, the math becomes elementary. Take the ending total market cap minus the beginning total market cap divided by the beginning. Simple, brutal, and effective. Note if you forgot, the market cap equation and the weight equation are here. Let's bring in the players. To test the power of market cap, we use the controlled variable method again. This time, we bring out the long-ranging king of market cap, Apple, and the veteran Intel, who is also in the S&P family but has seen his value shrink significantly. The other players will sit this one out. Take a look at their starting market cap on January 15th. Apple is a massive 3.8 trillion giant, while Intel sits at only 230 billion. That is a massive 16 difference in size. Suppose Apple rallies 10% only, while the other four companies stay flat. How much does the portfolio move? 4.18%. Think about it. One single company moves the entire portfolio by over 4%. Now it's Intel's turn. Same scenario, the others are flat and Intel jumps 10%. The result? Only 0.16%? 4.18% versus 0.16%. Apple has 26 times the influence of Intel. Intel is screaming for attention, but to the market, it's just a pebble thrown into the ocean, barely a ripple. Why is this? Because to Mr. S&P, size is power. Under this roof, your voice grows exponentially with your market cap. This plants all the headlines you see about the Magnificent Seven hijacking the index. The S&P's bigger is better logic is destined to heavily favor giants like Apple and Nvidia, while turning a blind eye to the little guys like Intel. Round 2 was intense. The vibe is set. Let's jump straight into round 3.
Round 3.
Next up, our third judge. He's not like the old money guys before him. This Gen Z judge cares about one thing: fairness. In his arena, giants and underdogs are treated exactly the same. How? He splits the money equally. If we have a $5,000 portfolio, each stock gets exactly the same. No favorites. Sounds simple, right? But the math is a little more tricky. Since every stock has a different price, to get that same 1,000 value, we have to calculate the shares first. Take the $1,000 or the initial investment. Divide it by the start price. That tells you how many shares to buy. Then at the end of the month, you take those shares, multiply them by the new price. That gives you the ending value. Add them up, compare it to your starting $5,000 or the starting investment, and then divide by the start investment. That's your index return. Headache? Don't worry, I will show you a CFA hack in a minute that lets you skip all this mess. Okay, let's play. Control the variable again. It's the ultimate showdown. Apple versus the crypto kid, Merrill. Look at the table. This time, everyone starts with $1,000 worth of chips. The total pot is $5,000. Scenario 1. Apple goes up 10% only. Please note this. Since we only hold $1,000 worth of Apple, a 10% gain means its value becomes $1,100. The other four companies did not move, so they are still worth $1,000 each. So the total ending value is $5,100. 501,000 versus the starting 5,000. How much did the index rise? 2%. Now Merrill's turn. Same story. Merrill jumps 10% and the others stay the same. The result? Also 2%. Exactly the same. See the magic? In this world, tiny Merrill has the exact same power as giant Apple. If the return is the same, the impact is the same. Did you notice something? That 2% return is just the simple average of the individual returns. So forget this complex math. Just average the returns. It's the fastest way to calculate the move. But math is equal, but reality is not. Which is easier, making an elephant jump 10% high or making a rocket fly 10% high? Obviously, it's Merrill. So in the real world, equal weight indexes act like small cap indexes. They are easily moved by high volatility stocks like Merrill. One last level 1 takeaway: fairness is expensive. Notice that after the jump, Apple is worth $1,100, but the others are $1,000. They are not equal anymore. To stay fair, the judge has to sell some Apple and buy the others to reset everyone to $1,000. This is called rebalancing. It means a lot of trading and a lot of fees. Fairness comes at a price. All right, the games are over. Now let's check the final scoreboard and see what happened. You will see that in the exact same market, the winner changes completely depending on which parallel universe you are in. In the price-weighting universe, think Dow Jones, high price is king. So Goldman Sachs, with the highest share price, crushes the competition easily. In the market cap universe, like the S&P 500, size is the only thing that matters. So trillion-dollar giants like Apple and Nvidia run the show here. And in the equal-weighting universe, price and size don't matter. The player with the most explosive potential wins. That's how the little guy, Merrill, pulls off the upset victory. The lesson? No one wins every time. Giants dominate one game, but underdogs own the other. Finally, this is a wake-up call for your portfolio. No index is unbiased, and neither is your account. Check your holdings right now. If you usually buy 100 shares of everything, you've accidentally built a price-weighted portfolio. Your returns are basically driven by your most expensive stock. If you put $1,000 into each stock, you're running an equal-weighted portfolio. Just be careful. Volatile small caps might completely take over your performance. Once you get this, you will stop looking at returns the wrong way. If you are equal-weighted, stop comparing yourself blindly to the S&P 500. Why? Because when Apple rallies, the S&P wins. But when small caps fly, you might be the winner. Know the rules to know the game. Alright, that wraps up our 3 showdowns. Still hungry for more? I got you. In the next video, we are leaving the noisy trading floor and heading back to the quiet finance room. We are tackling the core of CFA Level 2, financial statement analysis. A lot of students think FSA is boring, but Level 2 is actually super practical. It teaches you exactly how to see through a company's camouflage. Next time, we are hosting an ultimate accounting showdown. We will look at the exact same investment and see how the numbers change if we use the equity method versus the acquisition method. I will walk you through a single case study to break it all down. Why does one method make the assets look bloated while the other stays skinny? And how does that headache-inducing fair value amortization quietly eat away at your net income? If you want to master this method, hit subscribe so you don't miss this CFA Level 2 survival guide. I'm Analyst Bytes. See you next time. Bye.